The matching low is a bullish reversal pattern indicating potential upward movement in the market after a downtrend. This pattern is characterized by two consecutive candlesticks that close at the same or nearly the same low point, signaling strong support at this level and a possible end to the downward trend. One variation of this pattern is the tweezer bottoms. Like the matching low, the tweezer bottoms pattern suggests a bullish reversal. However, it consists of two or more candles that do not necessarily have the same closing prices, but do show lows that are very close in value. The distinguishing feature of the tweezer bottoms is the presence of wicks on the candles that touch the same or similar low prices, further emphasizing the market's support at these levels. By comparing these patterns, traders can enhance their market analysis. Recognizing these subtleties allows traders to identify not just the potential for a reversal, but also the strength of market sentiment, helping in making more informed trading decisions. The matching low pattern, with its identical closing lows, might indicate a stronger level of support and a more pronounced bullish sentiment compared to the slightly more varied tweezer bottoms, which still signals bullish potential but with a focus on the wicks reaching similar lows. The on-neckline pattern is recognized in the world of trading as an indicator of bearish continuation within an existing downtrend. This means that even though there may be a brief moment where prices rise, suggesting a potential reversal or a break from the downtrend, the overall direction is expected to remain downward. The pattern itself emerges through the formation of two key candlesticks during a downtrend. The first candlestick is long and black, indicating a strong selling day. Following this, a white candlestick appears that opens lower than the previous close, but then closes slightly, yet notably, into the body of the first candlestick. This positioning suggests a struggle between buyers trying to push the market up and sellers maintaining control, ensuring the downtrend continues. Understanding this pattern helps traders and analysts to anticipate future market movements, reaffirming the importance of recognizing and interpreting such patterns correctly. The on-neckline pattern is a key formation in the realm of technical analysis, often signaling a bearish continuation in the market. It occurs when there are two distinct candles in a downward price trend. The first candle is long and typically displayed in black or red, indicating a significant decrease in price. Followed by this, the second candle is smaller and colored white or green, showing a slight increase in price. This second candle opens lower than the first candle's closing price, creating a gap. However, by the close of the trading period, the price adjusts to finish just at or marginally above the closing of the preceding long candle. This narrow finish line formed by the second candle's close, parallel to the first candle's bottom, is dubbed the neckline. The presence of this pattern suggests that despite a slight recovery attempt, sellers remain in control and the initial downward trend is likely to resume. For traders and investors, identifying this pattern is crucial as it provides insight into market sentiment and can help in making informed decisions regarding their positions. The on-neckline pattern is a term used in technical analysis that describes a particular formation on a stock chart, suggesting that the current market trend, specifically a downward or bearish trend, is likely to continue. This pattern emerges during a downward trend and is characterized by a long black candle followed by a small white candle. The long black candle represents a day where the market closed significantly lower than it opened, indicating strong selling pressure. This is followed by a small white candle which opens lower than the previous close and closes slightly above the previous day's low, suggesting a weak attempt at a bullish reversal. The presence of this small white candle after a strong black candle hints at a slight bullish attempt. However, because this attempt does not translate into meaningful upward movement and the closing of the white candle is near the low of the previous day, it reflects that the bears or sellers continue to have control over the market. Consequently, this slight bullish attempt is not strong enough to reverse the trend, signaling that the downward or bearish sentiment in the market persists. Understanding the on-neckline pattern helps investors and traders recognize that despite a brief and slight attempt by the bulls or buyers to push the prices higher, the overarching bearish sentiment remains strong. This insight allows them to make more informed decisions regarding their investment strategies, as it indicates that it might not be the optimal time to expect a bullish reversal. The on-neckline is recognized as a bearish continuation pattern, indicating an expectation that the current downward trend in the market will continue. This pattern typically appears during a downtrend and consists of two candlesticks. The first candlestick is long and black, representing a continuation of the seller's control. The second candlestick, however, is white and opens lower than the previous close, but then closes slightly into the body of the first candlestick, though not above it. This specific formation suggests that while there may be some buying interest, it is not enough to overturn the prevailing downward momentum. Understanding this pattern can be useful for investors trying to anticipate future market movements. The appearance of an on-neckline signals that the downward pressure on prices is likely to persist. This information can influence investment decisions, particularly for those considering short-term trading strategies. Recognizing and interpreting such patterns is a valuable skill for navigating the complexities of financial markets, offering insights into market sentiment and potential future price movements. Confirmation of the on-neckline pattern, which is a bearish continuation pattern, hinges on several critical factors. Firstly, one should observe continued bearish price action following the formation of this pattern. This means that after the pattern is identified, prices should proceed to move downward, affirming the bearish trend. Secondly, an increase in trading volume during the formation of the two candles that constitute the pattern is key. A higher volume indicates stronger investor participation and lends credence to the pattern's predictive power. Lastly, the presence of additional bearish indicators in the sessions following the pattern's emergence also serves as a confirmation. These indicators could include, but are not limited to, downward trends in moving averages or the emergence of other bearish chart patterns. Collectively, these factors not only confirm the pattern, but also reinforce the potential for continued bearish momentum in the market. The on-neckline pattern serves as an indicator of continued bearish sentiment in financial markets. It signals that the downward trend in a security's price may persist. However, the effectiveness of this pattern in predicting future price movements can be heightened when it is used in combination with other technical analysis tools and indicators. It is important to understand that the on-neckline pattern by itself is not infallible. Like any other technical analysis tool, it does not guarantee future market movements with absolute certainty. Traders and investors often use this pattern as part of a more comprehensive analytical approach, incorporating various technical indicators to validate or question the signals provided by the on-neckline pattern. These may include moving averages, momentum indicators, or volume analysis, among others. Combining these tools helps in creating a more robust trading strategy, mitigating risks, and identifying potential opportunities with a higher degree of confidence. In essence, while the on-neckline pattern can provide valuable insights into market trends and investor sentiment, its reliability increases when it is supported by additional analysis. This integrated approach to technical analysis enables traders to navigate the complexities of the financial markets with greater precision and to make more informed investment decisions. Combining the on-neckline pattern, a bearish continuation pattern, with other technical analysis tools like the relative strength index, moving average convergence divergence, and support and resistance levels, enhances the strategy for identifying entry and exit points in trading. The relative strength index helps gauge the momentum and potentially overbought or oversold conditions in the market. When this indicator shows a market that is overbought, it might confirm the bearish signal from the on-neckline pattern. The moving average convergence divergence, on the other hand, highlights changes in momentum, direction, and duration of a stock's price trend. A bearish crossover in the MACD could reinforce the bearish outlook suggested by the on-neckline pattern, indicating a stronger signal for traders to consider entering or exiting trades. Lastly, incorporating support and resistance levels with the on-neckline pattern can provide a clearer perspective on potential barrier points where prices might halt or reverse. If the price falls below a support level after forming an on-neckline pattern, it further validates the bearish continuation signal, offering traders a more robust framework for making trading decisions. Together, these tools create a composite picture that helps traders navigate the complexities of market dynamics with greater precision. A common mistake made by those analyzing market patterns is misinterpreting the on-neckline configuration as an indicator of an impending bullish reversal. This misunderstanding primarily stems from the small white candle that appears in the pattern, which might seem to suggest a shift towards positive market momentum. However, it is vital to recognize that the on-neckline pattern occurs within the context of an existing downtrend and is essentially a bearish continuation signal. To accurately interpret this pattern, one should not solely focus on the appearance of the small white candle. Instead, it is crucial to consider the overall market conditions and wait for further bearish confirmation before reaching any conclusions about future market movements. This cautious approach helps in avoiding premature decisions based on a misread of the pattern and aligns with a strategic interpretation of market trends. By understanding the true nature of the on-neckline pattern as a continuation of a bearish trend, investors can make more informed decisions and avoid the common pitfall of expecting a bullish reversal that is unlikely to occur in this context. When traders identify an on-neckline pattern, it suggests the market might continue moving downward. This pattern is important because it indicates that even after a small attempt by buyers to push the price up, sellers have managed to bring it down close to the lowest point again. For those trading in the market, this can be a signal to consider short selling, which means selling a stock or asset with the plan to buy it back later at a lower price. Alternatively, traders might decide to stay away from taking any new long positions, which involve buying with the expectation that the asset's price will rise, until they see a strong signal that the market is reversing and starting to move upwards. To make strategic trading decisions based on the on-neckline pattern, traders may set their entry points slightly below the neckline of the pattern. This is the level that needs to be broken for the pattern to be considered valid. Setting exit points or stop loss orders just above the high of the two candle formation in the pattern helps manage the risk. A stop loss order is an order placed with a broker to buy or sell once the stock reaches a certain price, designed to limit an investor's loss on a security position. So, if the market does not move as anticipated and the price starts to rise, the stop loss order helps to ensure that the trader does not suffer major losses by automatically closing the position at a predetermined price level.